Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
What happens in different rate environments? I had recently one of our longtime listeners to the radio show said, "Hey, Andrew, what happens if interest rates go down a quarter point or half a point or whatnot? Will that mean that my money market account paying 5% will go down as well?" Well, let's talk about that. You're listening to Andrew Agemy with Financial Strategies.
And I'm Daniel Agemy. And AAA, it's a good question, right? It's a good question. How do interest rates affect your investment portfolio?
Exactly. That's the big question. And people get confused when it comes to interest rates because there's two kinds of interest rates, right? There's short-term interest rates and there's long-term interest rates. And they work differently. I mean, just real quickly, back in the days when, in the 80s, right? Back in the old days when interest rates had the proper yield curve and the 5-year CD would be a higher rate, much higher rate than a 1-year CD. And the 1-year CD represented short-term rates and the 5-year represented more longer-term rates, although really long-term rates are 10 plus, generally speaking, I think would be the way to define it. And so this question that our listener posed was really asking about short term, but the one that really needs to be posed and we really need to look at is more importantly, the long term, right? Because most of the people, Daniel, who are listening to us today are either retired or approaching retirement, and retirement is a long-term need. And so if you're looking to short-term interest rates to take care of a long-term need, that's a bad way to look at things. You need to look at long-term to take care of long-term, short-term to take care of short-term.
Right, exactly. And so people intuitively know this. If you go into the bank and you say, "Hi, Mr. Teller, I would like a CD. What are CDs paying?" You would expect if you gave your hard-earned money to the bank for 10 years, you would get paid more than if you gave the bank your money for 1 month or 1 year. Why is that? Well, because you have more risk. If you're locking up your money for 10 years, you don't know what's going to happen in 10 years. You don't know what's going to happen to this bank in 10 years. There's more risk than if you give them your money for 1 year, right? Mm-hmm. And that's the yield curve. You get paid more for more risk the longer you want. Well, we have an inverted yield curve, as you just said, AAA, which means if you go to the bank right now, you could probably get 5.5%, maybe even 6% for a 1 month CD. Mm-hmm. But if you want a 10-year CD, it's probably going to be about 3.8, maybe 4%, maybe 4%.
Right.
And that makes things difficult. That makes things difficult for savers, for investors, for retirees, because as you said, we'll have people come in and say, "Well, I'm rolling over CDs every year." And you felt really smart last year. This year, when you're trying to get your 1-year CD, you probably feel a little less smart. And who knows what will happen next year.
Right.
But if you had locked in a 5 or 6% CD for 10 years in October of last year, you're probably feeling pretty smart right now because that's gone up tremendously. The value has gone up. Now, maybe not in a bank CD because the bank takes the volatility. But if you bought, let's say, the US 10-year bond.
Right.
Right. And so how that works is rates and yields, or the value of the bond. We get into this a lot, right, AAA? But we're going to try to break it down a little bit easier for people to understand. The value of the bond and the interest rate do the opposite of each other. Okay? So if you have a 10-year bond at 5%, you're going to get paid, a U.S. government bond, you're going to get paid $500 a year. It doesn't matter what happens to interest rates. You have that guarantee. I'm going to pay you, the government says to you, I'm going to pay you $500 a year. And at the end of the 10 years, you're going to get your $10,000 back. Now, if rates get cut in half, the value of your investment will go up. So now your $10,000 bond might be, there's a mathematical equation. You actually can figure out how much it will go up per interest rate cut. But we're just going to simplistic say goes up to $12,000. Now your $10,000 bond is worth $12,000. You are still getting paid $500 a year. Pretty good, right? That's pretty sweet. You earn 20% growth.
Right.
And you're still getting your $500 a year.
Yep.
Now, if it goes the other way and rates rise, so let's say that they raise rates up to 7%, maybe the value of your bond comes down. Why does it come down? Well, it comes down because if they're issuing new bonds at 7% instead of 5%, who wants your 5%? Right. So it has to come down. The value of the bond has to come down to make it attractive to people. And so it would bring the value down so that the yield would be paying about that 7%. So it works like a teeter-totter where if rates go up, the value of longer bonds comes down. And if rates go down, the value of longer rates or the value of longer rate bonds go up, right? And what that allows people to do is that allows people to get the TR equals I plus G. It allows them to get the income, but it also allows them to get growth, mathematically calculated growth on top of that income.
You're exactly right, Daniel. One of the reasons why you're listening to Financial Strategies, Andrew and Daniel Agemy, is because people don't know what people don't know. And people don't know a lot of things about bonds. I'm constantly talking to people who say, I don't like bonds, but they're saying I don't like bonds because they don't understand bonds. Because in that example that Daniel just gave a few moments ago, that $10,000 bond paying $500 a year, 5%, and if rates go down, the value of that bond goes to $12,000. That's a total return of 7% per year, 5% coming from the I, 2% coming from the G. And that's where we get TR equals I plus G. Total return equals income plus growth. And on people who are just buying Tesla, Tesla is only growth. There's no I to Tesla, as far as I know, unless they came out. But some of these companies are exactly that. None. Okay. Still that way. Okay. So point is that we have a paper we'd love to put you in hand to help you explain this a little bit more called TR equals I plus G guide. And it's free for the asking 800-725-7616 for your free copy. Call up and ask for it by name. TR equals I plus G. Yours for free. You're listening to Financial Strategies because people don't know what people don't know. Today's topic is what happens in different rate environments. And Daniel, that's a great example of how an individual bond works. And that's why we are always saying that bond funds are not safe, right? Because you don't own the bonds. You can't get the money back at maturity, where in an individual bond like that, you get it back. And it doesn't matter. In the first example, you said the $10,000 bond, the rates get cut, $10,000 bond goes to $12,000. In your second example, you gave that of rates going up, and that $10,000 becomes a lesser number, like $9,000 or $8,000. And it doesn't matter because at maturity, you're guaranteed to get the 10 grand. It doesn't matter what your statement says. What matters is the maturity. And that's what makes individual bonds safe. So part of the key is buying the bond at the right time. Like we were talking and you said in October of 23, the 10-year treasury was paying 5%. You could buy it at 5%, 5 years, 10 years for 5%. Beautiful thing. But that's not what they are today. You can't buy that today for that. So for the good news on the short-term rates are they're paying 5%. The bad news on the short-term rates are they're paying 5%. Or a different way to put it, the bad news on the short-term is that they're short-term. And we don't know. We don't know what they're going to be for long-term. Like I said earlier, if you have a long-term need like retirement and you're putting money into short-term investment like that, that's wrong.
Right. Right. And that's why we dislike bond funds so much, is because you're giving up these two returns. Right. So we were on this show, AAA, you and I were on this show, And shame on you, listeners, if you heard us talking about this and didn't do anything. We were on this show in October because it was obvious that rates were not going to stay where they were. We were on this show hammering, begging people, make a change, right? Because we were picking up these corporate bonds, these solid balance sheet corporate bonds that I had never seen this type of, maybe except for some time in 2008, which was very difficult, or for a couple of days. It was just a couple of days during COVID. These solid balance sheet companies that we were getting 7.5%, 8%. And now these things are paying about 4.9, 5%, 5.3. And as we talked about, these are not 10-year. These are probably more like 6-year corporate bonds because we don't like going out 10 years typically. You've got all that appreciation. And now we're flipping out of these things because basically what has happened is the longer end of the bonds have come down. So basically what that means is the Federal Reserve is controlling short-term rates. So they're setting the rates, right? So I think it's like 5.25 or 5.5 right now. Mm-hmm. And so if you went and bought a 1-month Treasury note, you would get 5.5% for 1 month. Mm-hmm. When that comes due, you don't know what you're going to be able to renew it at.
Right.
With all the craziness that has happened with Japan just recently and with the Fed Chair Powell coming out and saying rate cuts are likely in September, the longer end of the curve has already cut rates. So before his meeting, I think it was trading at about 4.2, somewhere around there, like July. Yeah, around July 1st, right? It was probably like 4.4. And today it's somewhere around 3.9, 3.8. So the longer end of the curve or the bond market has already cut rates about 50 basis points or 0.5%. The shorter end of the curve, or what the Federal Reserve is controlling, has not cut yet. But you can see the difference where the bond market is saying rate cuts are needed, and the shorter end of the curve, they're saying we're going to hold this where it is, and we'll see who prevails. Right. But what we want to talk about, not what's going to happen, because we don't care what's going to happen as much as we care we're prepared for what happens.
There you go. Being prepared, right? Being ready, right? Just like Royal Rangers, ready, right? And that's exactly the point. Boy, that's pretty exciting. So in that example that Daniel's just given, it's called an inverted yield curve, where the short-term rates are in the 5 range, the long-term are in the 4 or below. That's inverted. It's supposed to be the opposite. The short-term is supposed to be the low rate, and the long-term is supposed to be the high rate. So that is also problematic and shows things in regard to the economy. But again, the key is being prepared, and we want you to be prepared. So we've got a book to go along with today's show called my mind is going blank. The Richest Man in Babylon, which is great. A great book, easy to read book. This book is recommended by a lot of people. It's a classic, easy to read, but it helps wherever you are in life and trying to accumulate wealth, whether you're a young person or you're retired person. This will help you be able to understand your money and understand how to invest better and easily. Like, for instance, you don't give your money, he says in here, you don't give your money to the blacksmith to invest in diamonds, because the blacksmith doesn't know anything about diamonds. So why would you give him the money? But that's what people did in this book, and they lost their money. So anyway, interesting book. Yours for free for the next 5 first-time callers, 800-725-7616, 800-725-7616. Or if you're a client, please call. We put this together, these shows and these books for you guys especially. We want to help you to be an educated retiree, because we believe an educated retiree is a happy and stress-free retiree. Call now for your free book. Next 5 first-time callers, 800-725-7616, The Richest Man in Babylon. We'll be right back after this.
The biggest mistake retirees make is not switching from the growth model to the income model. You know, a good retirement plan is having enough income to last the rest of your life. Any problem in retirement, it can be solved with income. The biggest concern that retirees have is running out of money. The second biggest concern is that they want to grow their money. so that they don't run out of money. And they think it's synonymous when it's not necessarily the case. People don't know what they don't know. And they're not going to know unless somebody tells them. People think that the only thing that they can do to grow their money is by investing for growth in the stock market. And it's very much a herd mentality. But you can only get growth when the market goes up. When they invest for income, they're able to get money no matter what happens. I'm Andrew Agemy, founder and CEO of Agemy Financial Strategies. We've been helping people enjoy stress-free retirement for over 30 years.
This is Financial Strategies with Andrew and Daniel Agemy.
AAA, I was talking to one of our clients the other day doing a review, and we're going through the portfolio, and he gave us maybe about 450 or so a year and a half ago. And I said, I got some good news for you. You made $60,000 in dividends and interest. Not bad. Are you happy with that? And he was $60,000 in a year and a half on $450,000. I think is pretty good with half the risk of the market. I'd say that's pretty good.
That's like 12.5%.
But then I said to him, well, if that's not making you happy, I got even better news for you. You made $95,000 of growth. Now, we don't shoot for growth. Right. We shoot for the I, right? We shoot for income. But you can get growth as well when you shoot for income first. It's the equation TR equals I plus G. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. An educated retiree is and stress-free retiree. Daniel, that is amazing. That's like a 33% return on his money in that year. Well, actually, you said a year and a half, I think. So it's a little bit less than that, right? So maybe 25% a year, right? Which with less than half the risk of the stock market is phenomenal, right? Because it's not just what you're making. It's what's the risk for what you're making? Because you can, your account value can go up, but if it's really high risk, it can go down. Just like a lot of people's accounts went down. The stock market went down. As we're recording this, was just a few days ago that everything broke loose in the Middle East, and with rate cuts being spoken about and all the different things, upheavals in the country, in the world rather, and the market came down. But yet if you're at less than half the risk of the stock market and you're making 25%, well, to me, that's a no-brainer.
Well, that is the goal, right? That is the goal, is to get income first, because the 60,000 off of that portfolio right now, the portfolio is worth 600,000, so roughly $150,000. The idea is you can depend on the 60, so it's not mattering what's going on, right? It's not mattering what's going on. You can pay your bills. If we go into recession and asset prices come down, that means you have $60,000 a year of income. You can invest in whatever you want. Take advantage of the deals that are available. Pay your RMDs, support your lifestyle, whatever you want. You have complete flexibility. But when it's managed properly, you can also get growth. It's not promised. The growth's not promised. But when we're investing in these corporate bonds, especially like we've talked about, there's a mathematical certainty for returns. And so he was participating in what we were talking about, where we're buying 10,000 bonds, corporate bonds, at maybe $7,000 or $8,000. We know mathematically that we're going to get $10,000 for that bond, right?
Right.
We calculate it to maturity. So we say if we buy a 6-year bond, we buy a 6-year bond and we pay $8,000 for 10 bonds. We know we're going to get $10,000 in 6 years. But what can happen is if rates change, which they did, that's why we went through where the 10-year treasury, right, was at in October of 23, because as the rates were cut from that 5% to the 3.8 or 3.9 that it is now, that brings the value up. So you don't have to wait to maturity in that situation. So these bonds went from under par, right? Under that $10,000 a bond to above. So now they're trading above that. And then if you have an active manager, and again, this is why bond funds don't do you justice. They don't do your hard earned money justice.
No.
We are able to trade out of those. So now if it's not paying a high enough yield, we sold some bonds today actually that were paying less than the U.S. short term, but U.S. Treasury bills, right? They were paying less because the value has gone up so much. So we sell out of those things. Maybe we hold it in the money market until, or maybe we have a better bond to trade into where we can do the same thing again. And that's what's amazing about an active manager when you're talking about fixed income.
Yeah. Yeah. That's a beautiful thing. And that's how we've been able to get some really high returns for people with less than half the risk of the market. So do you listen to Financial Strategies with Andrew and Daniel Agemy? Today's topic is what happens in different rate environments, and with the rates, short-term rates being so high right now. But is that, that's good news, but is that what's going to happen in the future? Probably not. We know that rates are going to be coming down. So we have a paper that we love to give to you to be able to help educate you further on this. And the paper is called TR equals I plus G. Total return equals income plus growth. And understanding the risk associated with your investments, as well as where the growth is coming from. Is it coming from the income of the investments, from just the share price going up? If it's just the share price going up, well, the problem with that is it could become an L, a loss, by the share price going down. But as long as you got the money coming in from interest and dividends, it goes well. So we love to put this in your hand, 800-725-7616 for your free copy of the TR equals I plus G guide. Call now, 800-725-7616. You're listening to Financial Strategies, because people don't know what people don't know. Daniel, with these rates and what's going on with this, you and I had talked, and you said the market interest rates, maybe they'll come down 0.25%, which is not necessarily a big deal. Jerome Powell is talking about something along those lines, but that's not the biggest thing to be feared, right? If you're talking about interest
markets
rates
are salivating right now that they're going to cut rates, because the general thought is if you have a 5.5% money market, markets are less attractive to you, right?
Stock markets, yeah.
And not by some of the people we talk to.
Right.
But stop thinking about how much money you've made over the last 10 years and you say over 150 years, markets have averaged 9.5%. Markets are at, by all kinds of valuations, high valuations, and I can earn 5.5% in a money market account. What am I doing? Like, that's a 4% difference.
Right.
But things are at the high end of the value. So an average isn't like it does it every year.
Right.
So that's
unfortunate.
4%, right? So that means it will have negative years sometimes. Yeah. And it'll have more than 7% years sometimes, and it averages out, right, to that 9.5 over 150 years.
But I don't know anybody that's 150 years old.
Well, that could be a too, right? Because if you're in one of those windows where it doesn't do anything and you need money, that can cause serious problems.
Very much.
So the market is salivating, saying, well, if I'll cut rates, money markets won't be an option to people anymore, and they'll dump their money into the markets, which will drive markets up higher. And there's some logic to that, but typically, why is the Federal Reserve, or why would Jay Powell cut rates? Well, he'd probably cut rates if things are pretty bad in the economy.
Yeah.
Maybe they would cut rates if there was some big bank failures. Maybe they would cut. Now, I'm not talking about 25 basis points. If it's 25 basis points, it's just a token rate cut. That's not going to change much of anything. If it's 50 basis points, it's not going to change much of anything.
Yeah.
But if there was a bunch of bank failures, for example, or there was something else going in the market where people were really worried, maybe some of the real estate loans on some of these huge office buildings in Seattle or California or some of these big cities was going bad, and there was loans defaulting, huge loans defaulting, or the owners were handing the keys back to the bank, right?
Right.
Maybe something like that could draw a big rate cut. Maybe they'd slam it down to 1 or 2%. That's probably not going to be good for equity markets. It could be. We don't know. But again, our point is to help people kind of understand how rates work, right?
Right.
Because there's a lot of talk about these things, and it's not always as it seems. Just because there's rate cuts doesn't mean equities are going to the moon, doesn't mean they're going to the sky. Usually in 2008 AAA, when they cut rates because the financial crisis was so bad, they wanted banks to start lending money. It didn't work out that way, but they cut rates so that people would borrow money and try to get the economy going again, right? If you're thinking about expanding your business and it's going to cost you 7, 8, 9%, which it could cost you right now to expand your business, you need to get a really good ROI on that investment. You've got to be getting better than 9% and a substantially better amount than that 9% for it to make it worthwhile to go borrow money from the bank. But if you could borrow at 4%, now all of a sudden a 9% ROI is looking not so bad, right?
Right. Exactly. And so it's real interesting how all this works together. And the thing that I'd like to say is that people think of the market. When you say the market, right, they think of basically the stock market. But I want to tell you in our listening audience that there's different kinds of markets. There's the stock market. There's the bond market or the fixed income market. There's the real estate market. There's the used car market, right? All kinds of markets. And what is a market? A market is a place where somebody goes to sell something and somebody buys something. And what the worth is, what somebody is willing to pay for it is what it is. And so the big key is when it comes to bonds and bond-like instruments is what are the guarantees? How safe is it? And what is it going to actually pay you and not have to hope for? Well, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is what happens in different rate environments. And we have a book we'd love to give you to be able to help you just in any stage of life and accumulating assets called The Richest Man in Babylon. And we love to put that book in your hand and be able to help you to be able to learn more about that. Yours for free by calling us at 800-725-7616, 800-725-7616 for the first 5 first-time callers. Or if you're a client, please call for your free copy of The Richest Man in Babylon. You listen to Financial Strategies with Andrew and Daniel Agemy because people don't know what people don't know. Daniel in Denver today and Andrew's in Denver today. How about that? See the Rocky Mountains behind me? Well, call now for your free book. 800-725-7616. Call now. We'll be right back after this.
Strategy with Andrew and Daniel Agemy.
The year was 1981, and I was in Bible college. And senior in Bible college, I had some money I wanted to do something with. So I called up the guy that one of the people who means the most to me in the world, especially at that point in time, my brother Daniel, who you were named after, Daniel. And I said, hey, Dan, I got this money. What do I do with it? Well, I didn't know anything about money. I was in Bible college, right? And so he turned me on to some John Hancock mutual funds, and he said, here's some options here. And so I looked at the mutual funds and I looked at the money market. And when I saw what the returns were on the mutual funds and what the return was on the money market, I said, why would I risk my money by putting it in these mutual funds? Why wouldn't I just put it at 18% in the money market? And so that's exactly what I did, because the risk of putting it in the stock market at that point was not worth the reward in my mind, when I could get at the same or even better in a short-term investment like the money market. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. And today we're talking about how do interest rates affect your investments. AAA, I guess that you had a calling even back then, because you were able to evaluate, even with no experience, the risk reward, and say, hey, if they're going to pay me 18% to put my money in these money market funds, I'm going to take that. I'm not going to worry about market risk.
That's right. That's right. Well, Daniel, I think it's our Lebanese heritage. The DNA that God has given to us was part of that, and then, of course, with the biblical principles that come to us, passed down from generations and us picking them up ourselves from those who have gone before. All those things work together to be able to give us some insight into the decisions that we have made, do make, and will make from that standpoint. And that's, to our clients' benefit from that angle, because we bring this wisdom, we bring this experience with us to the table. So yeah, exactly. And that was a real interesting thing, because it's not about what you make, it's about, well, what's the risk versus the reward, right? And that's part of what happens with gambling. People gamble, and the risk, generally speaking, is not worth, they think it's worth the reward. That's why they're doing it, right? But when we're talking about people's retirement income, when life savings, well, do you really want to put the money at risk? Do you really want the hope? Or would you rather go with guarantees and promises?
Yeah. So an interesting thought. So you put it in the money market account because you wanted it to be liquid and you wanted to earn some nice return. You were going to have a family. You were going to do different things.
Right.
And so you needed the money. If you were at retirement age, another way you could have approached that was you could have bought a 30-year government bond at 18%. And people didn't do it. It's like, why didn't people do that back then? And people didn't do it because people thought rates were going to keep going up.
Right.
And they were scared that the value of their investment would go down. But what happened is, since then, rates have only gone down until about 2 years ago when we started hiking, right?
Right.
So if you had done that with $1 million, you would have got paid $120,000 a year, right? $180,000. Yeah, $180,000 a year for the next 30 years. And that's why. So that's not available right now, but that's an example. That's why we keep talking about this fixed income stuff, because that's an example. The other thing that would have happened is, if you had done that, you would have got paid 180 every single year, but the value of your portfolio over that time would have doubled or tripled. It might even quadrupled over that period of time.
Oh, with the interest rates going down. Right.
But that's a different thing.
Yeah, that's
about the money market. Yeah.
Right. But the key here is, in me at that point in time, that was a short-term need I had.
Right. Mm-hmm.
A short-term problem that I solved with a short-term investment vehicle. That's what money markets are, short-term investment vehicles. Versus if I were in retirement age at that point and, had a long-term problem as far as retirement goes, that's where you need to solve it with long-term investment strategies. And that's what we're talking about today on the show. That's what this show is about, right? That too many people, too many retirees are looking at the short-term answers to their long-term problems when they need to be looking at the long-term answers to their long-term problems. And I don't have a problem. Well, do you need income? Do you need a check tomorrow or next week or next month or next year or 5 years from now or 10 years from now? Well, that's the problem we're talking about. Because if you keep investing the way you have always in your 401k and so forth, you're not going to have a check, at least without digging into principle.
Right. And that's why, especially today, it is so important to have an actively managed portfolio, because the indexing that has worked and the 60-40 portfolios, like the 60 portfolio people talk about all the time, and it's like supposed to work. But again, you have to think, if you were able to buy that 30-year treasury at 18%, what do you need the equity portion for? Because equity markets haven't averaged 18% a year over any period of time.
The past 40 years. That's for sure.
So it doesn't make sense. And then the same in 2021 when the treasury was like 1% and Silicon Valley went bust because they bought long dated US treasury. Why have any? Because you have downside, right?
Yeah.
They lost 40% or so of the value of the bond, and they were only getting paid 1%. So you can't say 60-40 is great no matter what. You have to look at the environment.
That's right.
And these institutions don't. They just say 60-40, and they don't look, oh, I could earn 6% in bonds right now when markets have only done, right? So you have to evaluate based on what's available, not on some antiquated rule that's not looked at based on the current environment. And that's what some of these big indexing companies are having difficulties with now, because it's just a set model as opposed to a manager, somebody actually evaluating the current situation and putting you in the proper place for that situation.
Well, it goes back to the definitions too, because even on that 60-40, when they're talking about 40% in bonds, they're not talking about individual bonds. They're talking about bond funds, generally speaking, which is not the same thing. It's like 100%, in the market, basically, is how it comes out, because it's all
without the upside.
Principal still is risk. Yeah. So definitions are important. Like I'm always saying, a 15, 16-year-old's definition of done compared to his parents' definition of done, two different things, but they're using the same word. So, in financials, you have to be careful of that, folks, in our listening audience. Always look at the definitions. Ask, what do you mean by that word? Don't assume you know what they're talking about. Well, we have for you today a paper that will be able to help you understand those words and those definitions, called The Case for Fixed Income. Love to put this in your hand. Want to educate you further. There's about 4 or 5 pages that will give you some more education, be able to help you understand the things we're talking about in a little bit more light, or at least to be able to know what questions to ask when you call us at 800-725-7616, 800-725-7616 for your free copy of The Case for Fixed Income. Ask for it by name, Fixed Income paper. Okay. And you listen to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And if you could listen to us, we're going to educate you on some of these things, especially be able to retire and stay retired. Daniel, we have still a lot more to talk about, right? We're talking about what happens in different rate environments. Today's show topic. We talked about a lot of different things, and, I'm interested, well, what happens, there's 3 different directions, right? That rates can go. They can go up, they can go down, they can stay flat, and what happens to people's portfolios? Well, the short-term portfolios are going to do one thing and the long-term portfolio is going to do another. I'm more concerned about the long-term portfolios, the long-term answers to retirees' questions, make sure that they are able to retire and stay retired. So, do you want to speak to that for our listening audience?
Yeah, absolutely. But first, let's just finish off, because you brought up money market funds.
Okay,
you invested in those. And I want to explain what those are for people who may not know or may not know how those work. So a money market fund is it's a short-term investment. It's a cash-like investment that can pay you. It can pay you interest and dividends, right? And so right now you could probably get about 5.25 or so in a money market account. It depends what type of investments they're investing in. So it could be invested in corporate debt, or it could be invested in government debt, right? And basically, a money market has to be invested in 13-month maturing securities or shorter, with an average maturity of 60 days or less. So it's weighted to 60 days or less. And right now, and what that means is you give a company your money, or you give a government your money for a period of time. So in this case, 60 days or less.
Yeah. And
they return your principal and you get paid interest in that period of time. So it's very easy for money markets right now, because a 3-month treasury is yielding, a 1-month treasury is yielding 5.5%. So they can just take all that money, put it in a 1 month, and it meets the requirements, and there's basically no risk. It's the government guaranteeing. The risk is what you're talking about. If you're a longer term investor, if those rates come down, the rate in the money market come down fast. So if Powell comes out and cuts by 50 basis points,
right,
those treasuries,
half a
those
percent.
one month, 0.5%, those 1 months will go from 5.5 to 5. And
Right.
then if there's some crazy thing in the economy and he cuts down to 2%, those won't be 5.5, they'll be 2%.
Right.
And so the money market, the percentage it can pay individuals can change very quickly because it's based on, as we said, 60 days, it has to be averaged 60-day maturities or less. So it can change very quickly within that 60-day window, the yields it pays you. Where's the risk come in on a money market? Well, the risk would come in is if everyone wanted to get it out at the same time and they couldn't liquidate that. So in the great financial crisis, they locked money market funds. Now, it's not a big risk because, especially in a government one, within 60 days, they'll come due and they'll be able to give you your money back. But you have to be aware that if you're not buying, that's why we talk about individual securities. If you own the contract, you know when it's going to come due. If you don't own the contract, you have to wait for somebody else to sell it or for it to come due. So money markets, we think, have a purpose for short-term money, and we're okay with not owning those individual instruments depending how much money you're talking about. But you also have to be aware it could get locked for some period of time until they can do the redemptions if everyone was trying to get out at the same time. You won't lose your money on a government-backed one because the government the U.S. government has a money printer. Yeah. They're going to give you your money back. It just may take some time. You might not be able to liquidate right away in a worst-case scenario.
Right. And that is great for those people who, have more than $250,000, right? Because, first of all, money market accounts, generally speaking, today are not guaranteed by FDIC. And but if you have it in a federal backed one, it's actually better than FDIC. So those people that have, $300, $400, $500 million, $1.4 million that you put in a federal money market account, it's safer than it is the bank from several reasons. Number one, the bank accounts, as we had talked about on previous shows, you're actually giving your money over to the bank. It's not your money. Yeah. They're indebted to you, but it's not your money anymore. Whereas in these accounts, it is your money and it is backed by the federal government. So it's a lot safer than the bank, to be able to understand that. And so that's cool. Well, I see that, well, boy, this time is really going well, Daniel. We need to take a break. But before we do, for our listening audience, you listen to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. We want to help you retire and stay retired. What happens in different rate environments is today's topic. And we have a book to go along with you, The Richest Man in Babylon. This is a great, easy read, classic book that will help you be able to understand principles, basic principles, like Daniel was talking about at the beginning of this section, that, I said, I think comes from our Christian DNA as well as our Lebanese DNA. But nevertheless, this stuff will give you good stuff. The Richest Man in Babylon, yours for the asking. Call 800-725-7616. The first 5 first-time callers, as well as any clients, please, clients, these shows are for you primarily, to educate you to be able to make smart decisions. And so you're more than welcome to take advantage of that. But if you're not a client, first 5 first-time callers, 800-725-7616. Call now.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you, so you can enjoy your retirement. It's a little more income stability.
I'm in.
That's 2 out of 3.
You're locked on to Financial Strategies with Andrew and Daniel Agemy.
The listener called in and he asked us, what happens if rates go down 25 basis points, 0.25%, Andrew, to my portfolio? What happens to my money market account? And, well, what happens to your money market account is one thing, but what happens to your portfolio is another thing. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. And today we're talking about how do interest rates affect your investments? And AAA, that's a great question. That's something we work very hard at to protect our clients' money,
Right.
to protect it from different things, right? There's
Right.
interest rate hikes where clearly it could bankrupt somebody. That's what happened to Silicon Valley. They raised rates, they were positioned wrong, and the bank blew up. Silicon Valley Bank, right? That happened to a
Right.
few banks, a year and a half or so ago now.
Yep.
There's market risk, right?
Mhm.
Where we go into recession, there's something going on, there's fear in markets and things sell off. And then there's theft or inflation, right?
Right.
Where prices are rising and you need to protect your purchasing power. You need to protect your lifestyle, as we like to say. And so there's a few different things. There's more things, but these are really three things that people tend to worry. I guess the interest rates people don't worry about as much, but it affects them more than they may realize.
Exactly. And when it comes to their portfolios, the same thing. I mean, most people are not, rates are not affecting most people's portfolio, but most people are invested in the stock market, even though they don't want to be 90% in the stock market. Most people have 90% risk and they don't even know it. I know that because all the time when I'm doing second opinions on people, they're telling me, well, I should have 10% at risk. And I look at their portfolios and they have 90% at risk. And they're dumbfounded when they find that out. But the key is with our clients, as far as the rates, interest rates, when they go up, when they go down, they affect our clients' portfolios in various ways. So let's get into that, Daniel.
Okay. And when you and I are talking about, for the listening audience, when Andrew and I are talking about bonds and equities, we are talking about real bonds that you own the contract to and real equities. We are not talking about funds. It drives me crazy when I talk to other advisors or I talk to clients who have money with other advisors and they say, I have this much in bonds, this much in equities. And I look, they have zero equities, they have equity funds, and they have zero bonds. They have bond funds.
Which are not safe.
And I guess that's proper lingo in our industry. But if I own equities, I want to own equities. And I want to know that company has cash flows. So that equity is based on cash flows, not hype. And if I own bonds, I want to own individual bonds. So I know what the contract says behind it. So as we're talking about these things, we are not talking about funds. We are talking about individual companies. And so a way I would structure a portfolio to be protected from these different things is, depending on the client's need, we like to own individual corporate bonds. And these individual corporate bonds, right, could pay anywhere from, we've been picking them up, 7% yield to worst, where you're getting paid 7% for the period of time. And we don't like to go too far. 6 years, when rates were really high, like when we talked about at the beginning of the show, when the U.S. Treasury or when the 10-year was at 5%, we were going out to maybe 10-year corporate bonds because the yields make sense. And we saw that if rates came in, so if the government lowered rates or markets lowered rates, that would drive the value of these 10-year bonds up. And we thought that was more likely than for rates to go higher and the value of these 10 years go down. But still, 10-year would be a very maximum. And so we don't like duration on the bonds. Why don't we like duration on the bonds? Because we don't want a lot of fluctuation. We're using those corporate bonds to add stability and solid income. So we want higher coupons so we know there's a ton of cash flow coming in. The other thing that you can do is you have bonds come due. So the shorter duration, if you buy a 1-year bond, that means that cash that comes due, you got $1 million portfolio. So let's say you got 2% in a corporate bond, that's $20,000, right? So say you've got two that come due within a year of each other, that's $40,000. If everything falls apart, you have whatever income that portfolio is producing. So that might be $65,000 a year, but you also know another $40,000 is going to be available for you to spend. So you've got $100,000 of liquidity over a year period of time without having to sell anything at a loss in a terrible situation, worst situation. You got $100,000 of liquidity on $1 million portfolio without having to worry about having cash, without having to worry about if there's a recession. So that's an example of how you can protect yourself. Now, if rates rise in that situation and the value of the portfolio comes down somewhat, you've got $100,000 in that case to invest at higher rates, and you benefit from rates going up. Make sense?
Yeah. Cool. This, and the point here is I want to draw the attention of a listening audience to what you said earlier in the program, the example of how you gave of the client who gave us $600,000 or somewhere in that vicinity, 500, 600, and made $65,000 or $65,000 of dividends in a year and a half, but also did $90,000 of appreciation of gains from that standpoint. So we get both. That's where the TR equals I plus G comes into play. So it's really cool. But if you're just joined us, you're listening to Financial Strategies with Andrew Daniel Agemy. And today's topic is what happens in different interest rate environments. This has been given to us by one of our listeners, longtime listeners. And we encourage you and our listening audience, if you have a question about things, call it in. Call in the question. Email us. Go to our website, agemy.com. The two words Agemy, spell our last name Agemy, AGEMY.com, and put the question in there. But today we have a paper to go along with the show to be able to help educate you further on this. And it's called The Case for Fixed Income. And people don't understand fixed income. They think they know the stock market. They know the real estate market. They know the used car market, but they don't know about the fixed income market. And this paper will help educate you so that you'll be able to make smart decisions so that you'll be able to retire and stay retired. So if you want that paper, call 800-725-7616, 800-725-7616 for your free copy. Daniel, I interrupted you, so take it, man.
Okay. So assuming rates go higher, how are people protected? Well, typically rates are risen when there's high inflation. So another thing that we're adding to our clients' portfolios, and if you're a client, we're doing this for you if you have managed money with us. We're adding these royalty and streaming companies. I think these are the best inflation beneficiaries. So as inflation goes up, these things benefit from inflation and they bring the value of the portfolio up. So even though you may have some of the bonds or the preferred stocks coming down somewhat because interest rates are going up, you have these things that can benefit from inflation and they tend to go up. Another thing is we put BDCs, business development companies, in the portfolio. And a lot of these work like an adjustable mortgage. So they give loans out at an adjustable rate. And so what ends up happening is if rates go up, they charge more to the person or the entity that they lent money to. And so it brings the rates up. As it brings the rates up that they're paying you, people want them more. So people buy these investments, which drives the price up of the investments. And so these tend to do well in high interest rate environments as well. Now, good so far?
Good.
Now let's flip it around and say they cut. Well, again, the actively managed portfolio, when that U.S. Treasury 10 note was at 5%, we went out to 10-year bonds. So if they cut those 10-year, and it already has happened, those 10-year bonds are going up in value. So there was bonds we were buying at maybe, $9,000, $9,500
for $10,000 bond. That was a $10,000 bond.
That now we're trading at $10,000, $10,000, $7,000, $11,000 for those bonds. So that's where that appreciation comes in. If it came from 9.5, to 11,000, you made $1,500 in appreciation, and you're collecting your coupon the whole time.
Yeah. So for our listening audience, to put that another way, everybody likes sales. So we're talking about a $10,000 bond that was on sale for $9,000 that we bought. I like that sale, right? Because that says at maturity, we're going to make $1,000. In that case, that's like 11%. Phenomenal, right? Just for that. But now that $10,000 bond that we bought for $9,000 is maybe worth $11,000. So that's a $2,000 increase. So on the $9,000 that we invested, that is like a 22% increase. And between, when we bought it and now, and so we can sell it if we want, take that appreciation and invest it in something else. Or if we like that coupon, we like what it's paying because it's paying us, what, Daniel, $600 a year, roughly $500 a year, right?
Yeah, $600 a year.
Maybe we like that $600 a year, so we leave it. Or maybe we sell it and we buy something else with that $11,000 that's going to pay us $700 a year.
Exactly.
Right?
Exactly.
So
and that's happening.
Compounding.
That's happening a lot right now on our clients' portfolios. Is there was some things with lower coupons that we bought really cheap, in like that time, that October, 23 timeframe, that now has come up so much. We've made so much appreciation. We're selling out of those things, just like you just mentioned, but now we're going into higher coupon stuff because as rates have been higher for a longer period of time, right? We've been on this rate hike cycle for some time. Companies are starting to have to offer higher coupon bonds. And when I mean that, instead of them issuing a 4.8% bond, that same company might have to issue a 6.8 bond or a 7% bond, right?
Right.
And so now there's more bonds with higher coupons in the market that we're able to take advantage of. And so we're looking at those types of things. Another thing that happens if rates are cut, right? We're talking about if rates come down, right? The preferred stocks in the portfolios will come up tremendously. So preferred stocks typically have a higher coupon and they're typically much higher, very high rated companies. These preferred stocks have longer duration. And so they don't perform as well as the rates are coming up. But when rates come down, these things rise tremendously. And so what our clients see is if rates get cut, the values of their portfolios will come up tremendously. It makes it harder for us as the managers because it's more difficult to find good deals, but they're happy because they see the portfolio value coming up very quickly.
Yeah. Very nice. Daniel, this is really cool. I really like where we're going, but we have to end the show, because we got so much more to say, right? But we need to end the show. And if you've been listening to this or just tuned in, what happens in different interest rates environments, what you've been listening to with Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. We have a book we'd love to put in your hand to be able to help you further. And of course, please, if you have any questions about what's being said today, email us or get us through our website, agemy.com, or call us at the 800-725-7616. Pose your questions so that we can either answer it on air or answer it directly with you. But in the meantime, if you like this book, The Richest Man in Babylon, which is an easy read, good read book, no matter what age you are, where you are in the investment process, it's going to add value to your life. You can have that for free if you're one of the first five callers, first time callers at 800-725-7616, 800-725-7616. And if you're a client, you get Sears for free. Well, it's been great being with you today. We look forward to catching up with you next time on Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know.